Welcome, everyone, to episode 14 of Top of Mind with Consilio Wealth. This is our second episode of the new year, and we are excited to chat through what's going on in markets right now. We're going to expand a little bit more on some 2023, just high-level predictions, as Hal likes to say. Predictions sure to be wrong. We are actually excited to put these down and then review them at the end of the year for you. And anyway, I think that'll be an interesting conversation. And then a couple other things. So before we get started here, Hal, let me kick it over to you. How are things?
What's up, Chris? Things are going pretty well. Pretty good start to the year, too. I know we've had, one episode this year, 2023? Mm-hmm. And it's Friday, 10 a.m. Pacific on January 20th. The market is higher. Right? Are you shocked by that?
Not necessarily.
Or at this point, should you be shocked?
I mean, last year was down kind of all year.
Yeah.
And it generally doesn't go down forever. And I think the market is feeling like we're closer to the end of the tunnel than the middle or the beginning. So I think they're starting to look positively and saying, we'll get through this.
Oh, yeah? Have you bought eggs lately? Have you seen the prices?
I have bought eggs lately. I feel like the last time I remember they went down by like 50 cents. But I think you're telling me that's not true anymore.
Well, I'm just highlighting what headlines are showing, right? What the media is really focusing on. Mm-hmm. Sure, eggs are expensive. That's because of the avian flu. But one, how many eggs are you really buying? Unless you're a restaurant or a baker or someone who's using tons of eggs, or like a weightlifter or something like that. But let's say, eggs are $4 a carton. What were they before? Does anyone remember how much of your net worth are going to eggs, even if they triple in price? Right? It's all about scale with the way I think of things. It sucks to pay more than what you think something's worth. But the media really has a way of driving the wedge home, because where you're spending more on eggs, I'm pretty sure you're saving in gas. Because the last time I checked, gas prices have been down since July of last year.
Yeah, a lot.
Yeah. Unless your gas budget isn't the same as your egg budget. So dip into that gas jar, put some into the egg jar, and then you're probably still out ahead. Unless you're a weightlifter who eats 24 eggs a day.
But it's good perspective, right? Because the things that inflate more or less are it's a weighted average. It's how much money you actually spend in that thing. And if that thing consumes $1,000 a month for you and it goes up by 20%, that's a big clip. But if the thing that is, $15 a month goes up by 20%, that's not nearly as much.
Let's say you bought a truck in 2022 and it was $1,000 payment, and you're going to complain about eggs. Okay. It's a little bit of perspective, I guess. Mm-hmm. But that truck is costing you more in gas if it's diesel or unleaded than any amount of eggs that you're probably buying, even if they increase in price like they have. And again, perspective, right?
Yeah. Yeah.
That's why I started how eggs are killing our wallets.
I'll come back to you. I'll send you a message this weekend, because I know we got to buy some eggs. So I'll let you know.
I can guarantee no one really remembered what the price of eggs were before they read the headlines or started paying attention.
Eggs are eggs too, right? I mean, if you're going to eat eggs, you buy eggs.
Yeah.
Versus you might say, I normally eat beef and beef has gone up, so I'm going to switch to chicken, or I'm going to switch to pork. Or in the veggie world, I've complained about the price of cauliflower, so I've stopped buying it. I buy broccoli now, or whatever, right? Whereas if you asked me a year ago, I would kind of alternate, rotate, whatever. So I think if you have many, many options for, say, a vegetable, you might pivot what you're buying. But there's kind of no substitute for eggs if you're going to eat eggs.
Yeah, but I think it's more of like this news cycle's version of gas prices going up, right? Mm-hmm. Now that gas prices going down, the media doesn't have much to say about it that would generate clicks or attention.
Yeah, no one cares.
Yeah.
It's funny. I was filling up at Costco the other day, and it was, I don't know, 3 something. And I was like, oh, it's under 4. And I mentioned it to the guy, there's like a person walking at Costco just helping people or whatever. like an attendant.
Really?
And yeah.
Our Costco
like
doesn't
if you,
have that. Yeah.
Well, like if your membership card doesn't work or something, and they want to get you out of the line. And so like I've had that issue before where I swiped and my membership card doesn't work, so it doesn't let me buy. And I'm like, hey, my card doesn't work. And he's like, he just swipes his own or whatever, and then it works. So anyway, so he was walking by, and I was like, yeah, it's under $4. And he's like, yeah. And all of a sudden we're having this conversation about how great gas prices are. And I'm just kind of looking around and everybody's smiling as they're filling up their tanks. Like, this is interesting. And so to your point, that's not in the news. And so we all sort of find out about it when we roll up to the pump on empty, and we're like, oh, what's it going to take me for today? Because the media, if you just followed the headlines, you would just think that it only goes up and never goes down.
Yeah. Yeah. On average, the average American spends about 3% of their monthly income on gas, which I'm pretty sure that's a lot more than any amount of eggs you can eat. The eggs would have to quintuple or 10x in price.
Do you know what percentage of income is spent on food in general?
I don't know. Actually, it's a good question.
That's interesting. Yeah. Okay. All right. Well, let's shift gears. So we want to do a quick review of market vitals on what's going on right now to give everybody an update. Eggs is number one. Number two is layoffs. So this has been top of news for a while, and big tech is all over the news right now with layoffs. So Microsoft laying off 4.5% of their workforce, Amazon, Google, Meta being the largest one, laying off 13% of big tech. And then you've got big-ish tech, Salesforce laying off 10%. And then you've got small tech, Coinbase, for example, I just saw in the news laying off 20%. I think that's their second layoff as well. And what's interesting about these things is that these numbers are all over the news, but these total amounts of layoffs are actually quite small relative to the number of employees. Coinbase at 20%, what sounds bigger, 20% or 950 people? 20%.
Yeah.
It's only 950 people that they're laying off. Microsoft's laying off 10,000 people. Okay, that's not small. But if you look at the hiring trajectory of these companies, I was looking at this right before we hopped onto here, and I pulled up Google's numbers. So Google had, in 2021, 156,500 employees. And according to Yahoo Finance, as of, I don't know, today or whenever this is updated, maybe last quarter, they had 186,000 employees. So you're telling me that there are 30,000 employees more over the course of the year, and now they're reducing by 12,000 of those.
Sure.
So we're really just rolling back maybe 4 to 6 to, at the most, 9 months for a lot of these big tech companies. So I just wanted to put that in perspective, that in the news it's saying layoffs, but this is not like these companies are dramatically shrinking. They're really just sort of rolling back by a number of months in terms of their hiring.
Yeah, well, even with that, we focus on the numbers, and if you're impacted by this is pretty stressful time. But on the flip side, you are most likely pretty marketable. These are very, very reputable firms or companies, and they have the smartest people in the world working with them. And if you were part of that fraternity, congratulations. But we're sorry if it is you. But we think layoffs are never fun, but for the health of the company, a lot of them had to lean out, had to start trimming.
Yeah. I mean, the unfortunate part to the employees is that the
lies
company,
behind those numbers. Yeah.
Yep. And the company and the boards, they have a fiduciary obligation to the company to keep the company healthy. And I think the hardest part of this is you look at a company like Microsoft that is unbelievably profitable. Like, why are they getting rid of 10,000 people? They can easily afford to pay all these people. But if their profit margins are getting squeezed due to slowing revenues or hiring faster than the actual demand has needed, they have to then go back and report to Wall Street and say, hey, we feel this is in the best interest of the company because of this reason. So I think the takeaway here, and I don't want to downplay anybody that is getting laid off. My hope is to provide just perspective on the sheer numbers from a company standpoint. If you are laid off, know that this is not about you. This is about what the board is trying to do to keep the company happy with Wall Street, to make earnings. So get those negative thoughts out of your head of it was me. It was the team that they decided to eliminate, and your name happened to be on that team. The other piece is that from everything that we've read, these companies are offering very good severance to their employees, and my ask, or I don't know if I can say advice, I guess my thought is take a quick review of your finances and determine if you can take some time. We all just went through the craziest last couple of years of our lives, where we used to go into an office, we used to have lunch with our coworkers, we might go right home, we might go play soccer on a soccer field that's close to work, maybe even on the Microsoft campus, for example. And none of that's happened in the last couple of years. And I think God, everybody deserves a break. So if you can just take quick stock of your finances, look at what your severance is, go apply for unemployment. It's there for this reason, and see if you can just take a couple of months to determine what's next. I think you will never regret that.
Yeah. Yeah. Especially if you're in the engineer role, there are probably going to be so many headhunters, ringing you, DMing you. I would take Chris's advice and take some unwind time, whether it's 2 months, 3 months, even 4 months, depending on finances, to just take the distressor and reassess what you want, because versus stepping into the next role that's open. Because I'm pretty sure that companies downstream that are still very good to work for are looking for highly qualified tech engineers or tech workers that, there might be 4 or 5 job openings for every laid off person right now. And we're in that weird labor market where the big tech companies are probably the first to shed. And they hoarded so much in the last few years that normal companies, right? Not the superstar companies, admittedly, but the normal companies that are still great couldn't attract enough good employees. And I think it's their chance to grab some really, really good stars here.
No question. Yeah. Take time, see what you want to do. And maybe it's a time for a pivot to a different type of company.
Yeah.
Maybe you've always wanted to do a startup and you this is the opportunity to do it. Startups are probably hiring less than the big companies just because they're usually funded by, money losing businesses. So they've had to pull back a lot as well.
Yeah.
But there are ones out there that are cash flow positive and are making money. And, maybe it's the opportunity to kind of collect your thoughts and say, hey, this is something I've always wanted to do. And make no mistake, some of the best companies in history have been born out of bad economic times. And so if it is risky joining a company that could completely go under, but, if that company does make it through and has a viable product, that company could be the next Amazon or the next Google. It's not a prediction. This is just a historical viewpoint of how things tend to work. So again, take time, try to not go apply right away, and know that you're highly, highly, highly marketable and will continue to be in the future. Yeah.
Yeah. And again, we empathize, and if you're a client of ours that's impacted, let us know, and we can help.
Okay, related to this, so there's a number of leases not getting renewed. So Amazon's not renewing a lease in downtown Seattle. For those that are at Amazon, it's the Port 99 building. And so Hugh probably met me in that building a bunch of times pre-COVID, and not anymore. They're not renewing their lease. No surprise. That was one of the ones that they leased, not owned. They own the South Lake Union campus, so they're trying to consolidate all down there. But also their comments on it were just reflecting how our workforce works now. We don't need as much of a footprint. This was in the news a while ago, but they've more or less paused, I believe it is 5 buildings in the Bellevue area. So they still have a footprint in Bellevue. This is Amazon still, but they've paused a number of buildings that they they were having built for them. So they're dramatically pulling back. Microsoft is not renewing a lease in Bellevue. It's the City Center building. So if you've met me there before, there's a great coffee shop in that building, by the way, called Anchorhead Coffee. Love that coffee shop. And unfortunately, they'll probably have to close their doors if they can't renew this lease quickly. But Microsoft's been in this building forever, and they're not renewing their lease. It is also up for, we'll see in the next couple of weeks if they determine this or not, but the Lincoln Square building, the one where way back in the day used to be MSNBC, that one's not getting renewed. And then the Bravern Towers, so far they haven't announced, so they might keep those. My hunch is that they're going to consolidate everything back to Redmond, but that's just some interesting news. And then lastly, Facebook or Meta is not taking their Spring Hill building. They're subletting it. So sort of interesting that they were going to build out another engineering center there on the Bellevue side, potentially bring a lot of life to the Spring District. They bought that building from REI. Those that have followed the news for a couple of years, REI built it as their headquarters, and then everybody at REI started working remotely. And I think that building became worth a lot of money, and REI said, wait a minute, why don't we just sell this thing and bring the profits, back into the company? And they moved their headquarters.
What if REI buys it back and makes it an actual REI store?
It's huge, so that would be quite an REI store, but yeah, and I think they moved their headquarters to Tukwila or something. So they went back to a lower cost area, and pocketed the difference. So anyway, just some interesting news on how tech companies are pulling back on their leases here.
Well, yeah, what started off as a joke, it kind of feels like the mall model where they have to repurpose and change their retail experience to more of a experience, right? Our local mall built a theater and a karaoke arcade place where Sears used to be. Like, what are these campuses going to turn into? Because it seems like mega offices and campuses don't seem to be, at least in vogue right now. I don't know if it was ever a fad, because I think there was a lot of success from Google, Microsoft, and Amazon doing this mind melding, right? Where you get a bunch of smart people in a room, you're going to probably get a lot of smart outcomes. But with this post-COVID world, is that even that much space even needed for any one company?
I think it's interesting because a lot of companies in the news recently are calling employees back. Salesforce just made the news on this. Salesforce, by the way, laying off 10%, 8,000 people. And they said very publicly, hey, our new people that are young are not productive. We need to get them back in the office. And that's not a bad thing, right? Let's get back in the office. It is actually shown that if you are in the office more and you are seen, you're more likely to get promoted. So I think for a lot of young people that are just starting out and wanting to prove themselves at a lot of these big companies, you got to be seen in the elevator. And it's good for meeting other colleagues and switching teams or whatever you might want to do. So I think the future of this will be pretty interesting to play out over the next couple of years. I think the footprint is less because you don't need all the employees at the office at every day, but maybe it's one's 2 days a week, one's 3 days a week, and these teams just switch. And to me, I just look at it as, actually, we have less real estate for more employees, and we actually have a more profitable real estate portfolio because we can service, say, 50% more or 100% more employees with the same campus level. So I think long-term, this actually becomes a really good thing for all companies that have office space because they don't need it 5 days a week. But we'll see. We'll see how we go. A lot will unfold.
Quite a few years ago, I interviewed at Google. I was lucky enough to get an interview. I did sign an NDA, so I can't say what was in there. But their campus, and this was like the satellite campus in the San Jose area, that had so many meeting spaces in very creative ways. You could tell they were encouraging really smart people to sit face to face to each other, right? So there was like a little mock beach and volleyball area, but it had all these seats dotted, but they were all facing each other, obviously for a meeting area. There were swings that were facing each other, right? So you can fidget and still talk to someone with 200 IQ across from you, and you develop something really awesome for Google. I think a lot of success has been born from that. versus through video where, admittedly I have a TV on, I have dogs in the background, I have other screens up, and I'm not 110% there. And I think when you physically get people, I think that's one of the biggest benefits is that mind melding. It's the camaraderie, the social aspects of it that spur, innovation.
Yeah, so we'll just see. I think commercial real estate's in for a bit of a bump because they're going to see a lot of leases not get renewed. I think that has a trickle down effect of the restaurants and the coffee shops and the stores and all the stuff that's downtown. If there's no reason to go downtown, the Nike store in Seattle just announced that it's closing. That's the only Nike store in the area, right? So this is a big deal. Now, I think in part they probably closed because of some of the violence and things. I mean, every time there was going to be a protest in downtown Seattle, they were the first to board up all their windows. So, there might be something else going on there. But
when's the last time you bought shoes in person?
A long time. I'm trying to remember. I can't remember.
It's probably been a decade for me, more.
We actually just bought some snow boots, because it snows here once a year, and I'm one of those people that doesn't actually have snow boots. So finally did it. They were on sale. Great. And one of the downsides of online shopping is that we have a store worth of boots downstairs because we have 2 different sizes for the 3 different boots that we ordered. And so, the company pays to ship us, 10 sets of boots, try them all on, and we're going to send 9 back or 8 back or whatever. Right. And it's like, gosh, I'm sure it maths out just like the credit union model that says, or the online bank model that says, we're not going to charge you any fees for your ATM card. And it maths out because if they don't have brick and mortar costs, they can pay for all your ATM costs. So, if say Nike doesn't have any brick and mortar costs, they can pay to ship back and forth and have all this inventory out, that's going to get returned. But yeah, that's the downside in my mind of online shopping is
carbon footprint goes way up though.
Goes way up. Yeah. And then I have to sit with it on a credit card for 10 days or 20 days or whatever, and then ship it back. And it's a pain, right? Whereas if I just literally went to the store,
one trip. Yeah.
I'd buy one thing and I would come home.
Yeah. It's weird, right?
So it is weird. Okay. Next item we had was the debt ceiling. The debt ceiling is in the news a lot today, yesterday, this week, because we officially hit it on Thursday. So what is the debt ceiling? Why did we hit it? We seem to hit it all the time. What does this mean?
Yeah, the debt ceiling seems to be an artificial political game. And we try to be unbiased here, but this one is obviously created by Republicans or more enabled by Republicans, where you get a Democratic president, Republicans play their one of their few cards that they have left because they don't really appeal to the majority of Americans at this point. But they basically set a limit for the U.S. credit card, which, sure, spending here and there might be out of control, but where do you cut spending from, right? Do you cut it from the biggest portion of our spending, military? Or do you cut it from Social Security, the other big part? Social Security is actually money that you and I paid into, so we're entitled to it. Military is tax money. So where do you cut from? I don't know. And if you're not cutting, you got to keep spending to keep the government or the country running, right? So the debt ceiling is an artificial ceiling saying we can't spend over X amount. And it's $31 trillion or whatever ungodly number there is. So unless you vote to raise the debt ceiling, which is why the Republicans set a vote, is because they wanted to control it where, well, we don't want to vote. We're going to let the government default, which could be bad for U.S. treasuries. It could be bad for U.S. government services like the post office, where if there's no money flowing, operations do need to cease, which is kind of weird if you think about it, because we pay for a lot of these services like post office and other federal and state programs that probably don't need to have a debt limit per se, because they are money making entities. But this weird quirk in how we vote on the budget and the deficit, Republicans are able to put a stranglehold on the country's spending. So no matter which side you fall on, I think this is pretty unnecessary, right? And we should tackle spending in more responsible ways, but this is how Republicans feel like they are in control. So the last time
seems like this happens, as this has happened in the past, it's always the opposite party, and there's always just trying to get a quick negotiation there. So if it's, in this case, it's Republicans saying like, nope, we won't raise the debt ceiling unless you give us this. And it's sort of a stalemate until that thing is honored, and then the debt ceiling does in fact go up. And we've seen the reverse too, right? We've seen Democrats hold out on this as well, saying, nope, we won't sign a increase in the debt ceiling until you give us this. And so this is really just a chess game of who's the president, what's their party, and then the other side. If you were to go back into history, you've seen this happen a number of times. So it doesn't really matter who's in office. It's always the other party that's trying to get something.
It's politics, right?
Yeah, because both parties have to vote to approve this. So it's a good chance to say, we're going to shut off your water here soon, so you better give us this to keep it on.
Yeah, and the last time it really came to a head was in 2011. The market did sink 16% from peak to trough, but the market did recover. If you got good memory, the S&P Global actually downgraded U.S. debt. So actually essentially made paying back those treasuries much more expensive in terms of a yield. Again, the U.S. could probably just print money and pay that thing off, but it did have an impact on stocks. Bonds, not so much. So if you're thinking of that a bond sell-off will happen because of this, it really did not happen. Bonds did not miss a beat, even in the face of the downgrade. That's because they, at the time, were a nice buffer to the stock sell-off. So stocks ended the year at 2% up, which is pretty good when you think about a 16% drop in the summer. So you recovered 16% losses in 6 months, but at the same time, bonds were up 7.7% in the year. So that means bonds were doing what bonds were supposed to be doing. And that's what the expectation we have this year too, is bonds have quite a bit more cushion because yields are finally out of the basement. They're probably on the second floor. They're not on the skyrise yet, or the suite level, but they're going to be able to insulate if we do get any kind of political gamesmanship that impact the markets. So far, the debt ceiling was hit Thursday yesterday. So far, the market has not blinked. So this could be a nothing burger, like politicians love to say, or you could forget political headlines in geopolitics in your investing, because if you look at it, the people that are playing this game, the politicians in Congress, I'm willing to bet they own stocks and bonds. Do they really want to hurt their own nest egg? And yeah, maybe they do. Maybe some of them have already sold out, knowing that this battle's going to heat up, which is highly, highly illegal. But again, we'll see what the SEC says about it. I don't want to really trash the SEC because they do look at us, but that's something that we can watch for, because there is a politician trade tracker that you could follow, and you could see all their trades, and they all own lots of stock, because they're most members of Congress and the Senate, the House and the Senate, are actually really wealthy. Mm-hmm. So for them to play this game, they're hurting themselves if they impact the markets with their politics here.
I guess that's good news, right? So if I'm hearing, it's kind of like the comments on, layoffs at the tech level. It's not great as an employee, but as a shareholder, the market's up today. But some of these companies that have announced layoffs, they're also up the day that they announced the layoff, because the market
Google's
says, well,
up
maybe
4%. Yeah.
There you go. Maybe we're a little bit more profitable now, and so the company goes up. And so you kind of, if you think about that in the world of politics, if I own the majority of my net worth in many of these stocks, but I'm also, holding out a standout to try to not raise the debt ceiling, how long can I really go before it hurts my own personal finances? And so in a weird way, that's actually good news for everybody, because you know that eventually there will be a negotiation.
Well, their interests are aligned with the market's interests, right? And
Yeah.
it'd be crazy to induce a bear market, which, again, I doubt it.
I want to come back to something you said there. So default is if we don't raise the debt ceiling, are we at risk of default, or are we at risk of government shutdown?
So 2011 was both. So the risk of default caused the credit downgrade to U.S. Treasuries, which essentially made it from like AAA rated to AA.5. It wasn't huge, but it was
one notch.
Yeah, and if you increase the yield on trillions of dollars, that's a ton of money in just interest changes, right? So that was the risk of default, the downgrade cost. The government shutdown was because, the funding, the debt ceiling was breached or maxed out. So if you have a credit card, you can't buy more clothes at Nordstrom, right? And if you got government employees, which bringing back an old term, furlough, like if the furloughs had to happen, right? We can't pay you. We can't, because we can't operate because we're not getting money from Washington, D.C. I think so. There's two semi-related things. So the government shut down because we couldn't get more money, and then two, the risk of default because we couldn't get money to pay previous debt back.
Because we do run a deficit, so we do need money to be issued to pay the interest payments, and so that's why the debt ceiling is both.
Yep.
Got it.
And the IRS, right? We're coming up on April. The IRS isn't funded. We can't file taxes, or I'm pretty sure they'll keep the IRS open for that reason, but you know what I mean? Like a revenue generating entity would most likely have to stop or furlough a lot of key employees for one of the key seasons of the year. Yeah,
because they turn it down to, whatever they call it, the key employees or key services or vital services or something like that.
I'm pretty sure IRS funded. Is key. It's key, but that I'm just using an example as what could shut down. Yeah.
Okay, lastly, according to Goldman Sachs, Europe will not hit a recession. This is somewhat surprising because they seem to be, struggling. Oil prices being high and inflation and reliance on Russian oil. So let's expand on that a little bit. Why are they coming out and changing their view now and saying Europe might actually escape recession?
Yeah, when I saw that article you sent, I initially said transitory because a couple of things that were cited there that I was like, it was first was abnormally warm weather. Again, last time I checked, we're still in the midst of winter, and things, as we all know, right? The U.S. just survived a cyclone bomb, right, in the Midwest and cold areas where it dipped negative, and then it came out, right? That's not to say the reverse can't happen with warm weather, right? So one of the things cited was unseasonably warm weather, and the use of natural gas came down as a result, right? You don't need to heat your home when it's 60 degrees out. You're fine. But weather's weather. The last time I checked, the weather doesn't stay 60 degrees all the time in the dead of winter. And if it does get cold again, do they change? Maybe not. But that's encouraging that as a result, the European performance relative to the U.S., and a lot of people don't know this, it actually did a lot better. Mm-hmm. So in the last year, Europe beat U.S. by nearly 6%. And
that's a lot.
Yeah, since October. Yeah. It's beat them since October. Europe has beaten S&P by 3%. And again, that's one of the biggest run-ups in a 3-month period I can remember. It's because people like Goldman are stamping that the recession is over in Europe. And I would be careful about that. But at the same time, it shows you why you keep allocations or keep investments in places that you don't feel so great about, because things like that happen. They surprise, right? And that's what diversification is. So
right. Don't trade the headlines.
Yeah.
What did they say? I heard this recently. The media has accurately predicted 20 out of the last 10 recessions.
Yeah.
It's like, yep, of course. Maybe even 30 out of the last 10. So this is no different.
I'm kind of coming around on that because as someone who writes pretty regularly and trying to find topics to write about, it seems that if there's no bad news, it's actually been tougher to write, admittedly.
Mm-hmm.
And if there's no bad news in your job as a writer for a CNN, for example, what are you going to do? You're probably going to nudge people towards, hey, recession's coming.
Mm-hmm.
But Goldman did create quite a few headlines by writing this because they were so against the grain. Because we do watch quite a few research firms. It's like 90% are calling for a recession.
Yeah. Well, and the main point is that they said natural gas prices have fallen back to September 2021 levels. That's big.
Yeah.
That's big.
That's because demand went way down, right?
Demand went down. Yep.
Yeah.
Yep.
If it's weather related, I probably wouldn't put too much on that. But they have other reasons. It's just when you think the obvious is going to happen, we have a weird way of proving everyone wrong.
Yeah. Well, I think they're actually, because they're not as reliant on Russian oil anymore. They've been able to build other trade partners.
Reroute,
I believe the U.S. is one of those specifically for natural gas. And so, if there's additional exports that are going into Europe that are providing a lower cost product, that's also helped lower prices. So, maybe that does. Maybe they escape recession. I don't know.
Yeah. And if they got their soft landing because at this point their inflation is at 9.1% as of the last reading. That's 2% higher than the U.S. So
is that annualized or month over month?
Yeah, it's annualized. Yeah. I know
You're killing me.
It's actually a negative month over month reading because their peak was 11% in the summer when our peak was 9.1%. But yeah, ours has come down from 9.1 to 7. Theirs has gone down from 11 to 9.1. So inflation's coming down.
Ours is annualized at 0.3 for everyone, so it's actually only 3.6. So not as bad as the media says it is.
Yeah, and if we're using the same type of measurements where I'm measuring March 2023 of March 2022, remember March 2022 was climbing? We're going to measure March 2023 averages over 22. Mm-hmm. That should actually, by that rationale, we should show negatives pretty soon. Mm-hmm. But we all know, that month over month is probably the better way to look at things. Mm-hmm. And specifically looking at eggs, right? Just focus on eggs and you'll be okay. Mm-hmm. But yeah, that's year over year. They do have a ways to go in taming that though, Europe, taming that inflation. But that's because they have a strike in supply chain workers. I think is ports in England. They want to strike, rail strikes, similar to here. So their union representation is actually a little bit more healthy than the U.S. Because they have just a lot more old world industries that are running there, right? Mm-hmm. So I think they got a ways to go. I wouldn't say inflation's out of recession's out of the cards because I think recession's the best medicine for high inflation. Even though the month-over-month numbers are improving, that the level of prices is still too high. If that makes sense.
We've been saying this a long time. The fastest way to heal this is if we do officially, by whatever definition, fall into recession. That does probably mean more layoffs because this job market is so insanely strong. Layoffs, by the way, are really centered in the tech industry, which I know is a lot of our clients and listeners, but when you look at other industries, there's not nearly as many layoffs. So recessions typically are layoffs across the board versus in a single industry. So, the economy is actually really strong because of it. Yeah. And that's likely how we've avoided recession to this point. But if we do fall into recession, people stop spending, that brings inflation down, and we can correct this thing very quickly. So the R word will be celebrated by the media, but, are we actually closer to the end? I've said this for a while too, in a kind of weird, twisted way. I think if we do officially fall into recession, the market might actually go up, because the market will view it as we're closer to the end than we are the beginning, and we're through the middle. And a lot of this is what's called priced in. So how you talked about how emerging markets and international markets have actually done really well in the face of otherwise really bad news. It's because the previous returns were pricing in even worse news than is right now. And that's really how markets work. It's how stocks work. Many of these big tech companies are now considered value companies, which we defined this a few episodes ago. But a value company is a undervalued stock.
Yeah, it's Facebook, it's Netflix right now.
Exactly. And I mean, Meta jumped off of like a $80 or $83 52-week low to, I think they're 120, 130 at this point. I mean, that's a lot. That's a big swing. So, it's when markets price in a worse than actual outcome, then you see positive returns. So I think this year is going to be very interesting. I think the next 3 to 6 months is going to be interesting as news shakes out and hopefully starts to get a little bit better. News, I should say economic data, then that should hopefully propel us a little bit forward.
Yeah, I like to say that, what are you going to tell the market that it already doesn't know?
Right.
Because you're competing against the likes of the Goldmans and the BlackRocks and yada, yada, yada. But also every single retail trader in the entire world that's trading in the U.S. markets or global markets, right?
Mm-hmm.
Like, who saw this European rebound coming, which is already occurring, right? Like, it's already months old. Did you see it when, like, it surprised me when I look back at the data. I didn't see it in the moment, even as it was happening. And where was the green light here? Where was the go ahead and let's go invest in Europe? Right?
It's never a green light.
Yeah, the news was super, super negative there. So to assume that you can beat the market that way, it's just folly. It's just really tough.
Well, in the last chart here that we can cover, the S&P, I'm looking at a chart of the S&P 500 since 1980. It's only been negative 2 years in a row once since 1980, and that was after
to end the year, yeah. To
end the year, thank you. Yeah.
Yeah, during the year, yeah. We all kinds of weird stuff going on. Yeah.
During the year, average drawdown is about 15%. So you can expect to see at any point in the year when you log in an average of a 15% decline. Last year's decline at the bottom was 25, finished the year at minus 19. So there's a pull up, that is, from the lows in October. And we're up a couple of percent year to date. But when I look at the 3 years actually that were negative in a row, it was after the tech wreck. And then the market was positive for a while after that. But only one year followed by, I don't even know the average here, but 1, 2, 3, 4, 5, 6, 7, 8, 6 to 8 years of positive returns.
Yeah.
Not a prediction. Might not happen, but we know that the market generally, 32 out of 43 of the years that are on my screen, is positive.
Yeah, well, we're only up 2%, but Europe and emerging market are up 7% and 8.44% respectively. So
look at that.
You got to own a little bit of everything.
Yeah, I don't know. Yeah. Okay, good deal. Well, that's all the time we have today. Thanks everyone that's joining us, and we will catch you again in about 2 weeks.